Guys and girls, welcome back to another Bum Outlooks video, and today we're discussing cross-market hedging. Cross-market hedging, what is it? Now, it's a strategy used by traders and investors to protect their investments from adverse movements in the market by taking positions in one or more related markets. Indeed, it is an advanced method of trading, and it is an advanced technical method where you are mitigating risk essentially. Now, in the context of foreign exchange, this involves using financial instruments in correlated markets to offset potential losses in your currency, your FX positions. The rationale behind this is based on the relationship between different financial markets, such as currencies, commodities, bonds, equities, all of which can exhibit predictable patterns of correlations under certain economic conditions. Now, from a hedging strategy point of view, as an FX trader with a long CAD dollar position, which is of course short USD CAD, you might hedge against this potential decline in the Canadian dollar's value by shorting oil. Because if you're short oil, as the value of oil decreases, of course, the value of CAD would decrease as well. So if you're long CAD, you'd be short oil as a hedge, cross-market hedging. Now, the Japanese yen and the Nikkei 225. The Japanese yen is often, referred to as an inverse relationship with the stock market of Japan. The yen is considered a safe haven currency. So in times of global uncertainty, investors might flock to the yen, causing it to appreciate while equities decline. So how do you, deploy a strategy that hedges this? An investor holding a long position in yen and anticipating a market downturn might hedge by taking a short position in the Nikkei, as they inversely correlate. The bond market. The relationship between the US dollar, which is USD, and the US Treasury yields can be significant for traders. Generally, higher US interest rates and yields can attract foreign capital, boosting the dollar's value. So how do you hedge this? Well, an FX trade expecting the dollar to strengthen due to rising interest rates or interest rate expectations might hedge the currency exposure by buying Treasury futures, benefit from both appreciation of the dollar and the gain in the bond prices as yields rise. Now, the Australian dollar and commodity hedges. Now, the Australian dollar is closely tied to the prices of commodities, especially iron ore and coal, which are significant exports for Australia. A rise in these commodity prices can lead to strong Australian dollar, which of course lead to increased export revenues. How do you hedge this? Well, an FX trader with a long position in AU, Australian dollar, US dollar, anticipating a decline in commodity prices, might hedge by taking short positions in iron ore or coal futures, or even copper. This strategy aims to offset potential losses in the Aussie with the gains from the commodity positions. Now, the Aussie and the ASX 200 hedge. Now, again, another hedge for the Australian dollar is the ASX 200, which is of course the Australian stock market. A bullish Australian stock market often attracts foreign investment, requiring the purchase of Aussie and thus potentially strengthening it. So to hedge this, if an investor expects a downturn in the Australian stock market, they may hold a slight long Aussie position, Australian dollar, so they can hedge by shorting the equities. This move seeks to compensate for any Aussie depreciation and profiting from the equity hedge, and of course vice versa. Now, the New Zealand dollar, we all know they export dairy, and it is notably influenced by dairy prices, especially the World Dairy Index prices, the WDIP, as dairy exports produce a large revenue flow for New Zealand. Fluctuations in the global dairy prices can significantly impact the New Zealand dollar's value. To hedge this, a trader with an NU long, NZD USD long, concerned about the falling dairy prices, might consider hedging with a short position in dairy futures or related derivatives. This approach aims to mitigate any New Zealand dollar losses. The same thing applies with regards to the NZX50 or the NZ50, however you get your ticker up. But ultimately, a long New Zealand and a short equities or vice versa to mitigate hedge, similar to Australian. Now remember, implementing a cross-market hedging strategy requires a deep understanding of underlying economic, geopolitical, and market factors that drive correlation between different asset classes. Traders must also consider the timing of entering and exiting these hedging positions, as correlations can vary over time due to change in market conditions. And at time, one side of the hedge can move before the other. So managing your trade is vital. Like I said, this is for more the expert or technical developed traders. And moreover, while cross-market hedging can reduce risk, it does not eliminate it entirely. Unexpected market events or shift in monetary policy can disrupt established correlations, potentially leading to hedging strategies not performing as well. So continuously monitoring this is advised, and adjustment of hedging positions are crucial when managing risk. So in summary, cross-market hedging in FX involves leveraging the correlations between currencies and other financial markets to protect against adverse movements. By proxy, you are mitigating risk. By understanding and exploiting these relationships, traders can enhance their risk management strategies, though they must remain vigilant to the dynamic nature of the markets we are operating in. That is cross-market hedging, guys and girls. I hope you'd enjoyed. Let's jump into the next video.